Hello everybody and welcome to Econometrics. Today we have a very interesting uh, video about the United States economy, and I'll try to give you a few hints about how inflation and FedFunds and money supply and consumer spending could be evolving in the next months and quarters. Yes, also based on the latest data that we got from the United States, and we saw that inflation has gone up a little bit, CPI to 2.7%, and that core inflation it's stabilized at around 3.3%, and the core producer prices are also stable at 3.4%. Food inflation has gone up a little bit, core PCE also has gone up a little bit. So these are all factors that have to be considered when trying to forecast and have an idea of how interest rate decision could be evolving in next months and next year, and how investors will have to basically decide about how to allocate their assets, what could be the economic outlook of in the United States economy. So for now I've gone through just about 10 or 12 time series, and it's hundreds of pages of data, and I apologize if I cannot go through everything, and I'll try to be as concise as possible. So yes, as usual, taking the time series data, and first things first, I basically did all the detrending of the time series with calculating the residual, the square residual, so that to have as less variance and as possible in lagged errors. And so then I went forward and I tried to have some forecast model with ARIMA, and basically this time I've been quite lucky, because I managed to ask the machine to come up with some optimized, like, best model fit for each time series. So for example, here the producer price index, the outcome is the optimal model for this kind of optimization is 201. So we don't have here 0, we don't have to basically calculate the residuals. We just have 2 AR and 1 moving average. And yeah, we can see that the p-values, the AR lag 1 and lag 2, two lags, they are statistically significant. One coefficient is positive, one is negative. And yes, if we just check out the graph, the chart is much easier. We see that the orange line is the forecast. It gives us a rising but volatile path of increase of producer price index. So basically data should show us going forward a rise in PPI, a small decline, and then a rise again. So this could be also maybe I don't know. I mean, if tariffs will be implemented, then going forward in 2025 we could see this orange line actually materialize and have a high producer price index. So the residuals, they are somewhat stationary. That's why I said at the beginning I have something like 800 pages of data, and I went through at least 3 or 4 different ARIMAs, tried to implement. I will show you the ARIMA with very flattish, very stationary time series. So just I want to go through this one. It has been basically optimized by the machine. We see here the machine has chosen 210, So two lags. One is to have one the residuals with one lag, and zero moving average. And this has been implemented. Is it same producer price index? What is the time series? Come on. Yeah, core stick inflation. Yeah, this is actually very very good, because a core stick inflation is a time series that in itself is not stationary. So the machine recognized that it needed to implement a residual calculation to have a forecast model that is more or less reliable. We see here a lag 1, lag 2 very significant. The seasonal AR it's significant. So these statistical values, they are reliable, they are can be considered. And also the sigma value, the p value also, it's statistically important, significant. And we have positive coefficient for the AR with 1 or 2 lags. And yeah, we see that here the residual are not the ACF has a lot of lag effect. Okay, the partial autocorrelation after the second period and the third period, we have some sort of stationarity, but it's not good enough. Okay, it's not stationary enough. That is not good enough. I mean, the machine does a lot of good work, but these models can be refined forward. Yeah, basically the forecast is for a decline in core inflation, but I want to remind you all that core inflation, it's a non-stationary time series, so there are a lot of errors, lagged errors that can create all sorts of spurious correlation and some out of skew results. Then going forward, CPI, we have an optimization for a 310, and then yeah, the forecast is that CPI it's going up to 4% again next year. And what comforts us is that the p values, they are very close to zero, they are very statistically significant, and also the AR data the first lag and third lag, they have positive coefficient, the second lag is a negative coefficient, and also the seasonal lag, also they are statistically significant. There is some heteroscedasticity, so there is some lagged error variance or volatility in model, but this is quite normal. I mean, it can be flat as you can imagine, but the models, I mean, these the outcome, they are pretty okay to consider as forecast, I would rather say. And yeah, going forward, then it starts to process the M2 real money supply, I hope so, yes. And then optimal model 202, and then yeah, the optimal model gives us very all variables or all data, all the outputs, yeah, all the statistically significant, the first lag, second lag, the moving average, the autoregressive seasonal lags, they are all statistically significant, and most of them, the coefficient, are all negative. So these are the outcome data that I'm learning to read, and what the graph tells us is that money supply is going to go up in next months and quarters. Bear in mind, consider that the shaded area is the confidence interval, so that means that there is uncertainty. I mean, the 100% is not 100% sure. So there is uncertainty. these residuals, they are pretty much stationary, so I would appreciate this output. This is core PCE, and we see that core PCE would be around this box. Now we are at this level. It would be going to 3%, and then it will decline. But we see, for example, that this variability, it can be traced back to this. For example, that the seasonal autoregressive lags, they are not statistically significant, so that explains that we don't have a neat and clear just forecast, but it's there is more volatility. The line goes up and down, so all the lag, the residual errors, they are not filtered to the model, but all these data, they are pretty good. And yeah, we have some appreciable stationarity here. And what else? Let's see what other forecasts I've got here. What do I have? Yeah, so this is core CPI, core inflation, and the model forecast that it goes down a little bit, but it will stay very close to 3%. Now here also there is a lot of variability in the orange line, and the shaded area also is quite large. And what basically told me that this forecast was it's not very precise is that you see these graphs, there is a lot of autocorrelation in the lagged errors. So this time series is not stationary, so there is a lot of seasonality. This one, the partial autocorrelation is more stationary, and yeah, a lot of seasonality we don't have in the seasonal lag. We don't have the statistical value, the p-values, they are not statistically significant apart from this one, but not even this one will make it. So that's why we have a lot of seasonality for core inflation, and that's why the models have to be continuously refined and worked through. So then forward, FedFunds. Everybody wants to know where the FedFunds goes. The FedFunds will go lower. So the model, the ARIMA, tells me with some level of accuracy that FedFunds are likely to decrease and go to 3.5% in the coming months and quarters. And yeah, this is total bank credit. So okay, yeah. So this is the station. Oh, these are for the FedFunds. So these are for this one. My bad, sorry. So let's go back and see. Okay, core CPI is quite stationary. Never mind. We will go through a lot of things. I'll try to be very quick. And yeah. So after the FedFunds, I have examined I asked for a best model fit for total bank credit, I believe. No. Yeah, total bank credit is this one. Yeah. And the forecast tells us, as we see, that the orange line, so there should be a contraction in total bank credit. I don't know. I mean, the residuals, they are stationary, but there is seasonal autocorrelation after the time period. Here, also here, and here. And I got lost at a moment. Yeah, the p-values are good. But I mean, yeah, let's consider for a moment that total bank credit will decrease, but I have different outcomes for money supply, so this is all very volatile. So then it went through the total credit card and revolving plan, etc., etc., etc. and we have our forecast. Yeah, for example, we see that contrary to total bank credit, there should be a production of an increase of line of credits for credit card plans, revolving credit plans, yeah, all that sort of stuff. Yeah, so let's try and go forward. Actually, I cannot see my screen properly. Okay, so I will show you going fast forward down another. Yeah, it's basically the same thing, and I tried to gather as much stationarity as possible. So I set the ARIMA at 111 because I took the raw time series, so I needed a differentiation, a residual in time series, and it worked out pretty well in terms of stationarity, because we have the whole time series, they are all stationary. The residual, the distribution is symmetric, but there are some large values which are like these are, you can see this in the kurtosis, right? If the kurtosis is larger than 3, there are outliers, like fat tails, large values which are outside the distribution, normal distribution, okay? And this is the kurtosis, yeah. So slightly positive, the skew slightly to the positive side, and yeah, the p-value, the moving average, it's not very statistically reliable. And yeah, for example, we see here that producer prices should be basically stabilizing, but we saw in the other page that producer prices will stabilize at a certain level and probably will go higher. But we see here the shaded area is very large, so there is a lot of uncertainty in the forecast, yeah. So consider all these things. Here, very stationary, so this ARIMA 111, it's good. The AR, it's okay. The moving average doesn't work very well. And yeah, this is the same for producer price index, pretty much the same. And we have a little tiny box with forecast data. I'm trying to make it clearer. Yeah, so month-on-month decline and month-on-month going up for January and February next year. But you see the lower and upper bounds, there are some wild outputs, which this is all the blue shaded area, which I would not consider at all. And then it goes forward, core inflation, and here the moving average works better, so the p-value is okay. And yes, core inflation, core stick inflation should continue to go down slowly, 3.9, 3.8, very slowly. And yeah, we have some kurtosis. Okay, so we have some outsized data, fat tails data. So what next? CPI stationary, but with some seasonal lagged autocorrelation after the time period, and residuals standard normal, but with +2, -2. Kurtosis is larger, 6.16, so that's larger kurtosis in CPI inflation. So it's there are some large data in CPI, and this large data, for example, like this, we have these kind of spikes. These are very large outliers, very large variation, -2, +8. So that's why the kurtosis then is very large, and the distribution has these values which are outside, very, very very far in the tail of the standard normal. Yeah. And CPI should stabilize around the values there is now, 2.6, 2.7. So we will have a sticky inflation. CPI will not easily converge to 2%, and this will pose a challenge. Will be a challenge for the Federal Reserve to reduce interest rate, and then it will be a factor that has to be discounted when you are applying CAPM models. So you want to discount what is your portfolio return based on the rate of return of standard portfolio minus the average interest rate. So if interest rates are higher, the CAPM is easier. In my view, it should be like that. But so here we have money supply. All the statistical value, they are good. Coefficient, they are all positive. It's stationary. We have a very large kurtosis, so there are a lot of outsized values in the distribution. Yeah, we see money supply distribution. It's symmetric around 0, and we see that it's normal between -2 and 2. Okay, then we have here this excess of money supply, which are very large, long and fat tails data, and these are the anomalies in money supply, and these fits through the residual, because it breaks down. I will tell you something which is very I'm sorry, I'm making a lot of mess. So when you have this, money supply is pretty stable in this range, okay, but here we have a big change, and it's before and after the financial crisis, 2000, the GFC, and here we have an even larger change. Okay, so when this data go all together, then this is a problem for any econometrics model and forecast to work through, because you have this period with large swings in percentage change that breaks down the model, and then the machine can work through the whole time series without interruption, but when you run some other kind of diagnostics, you see that these large swings, they break down the model. So the final outcome that you have, it's reliable, it's okay, but you know that the time series here is stable. Then you have this big breakdown in money supply that goes down and up very rapidly. So this incorporates a lot of volatility in time series. So when you go forward and work through this data, then it's more difficult to have a very precise forecast and a very precise study of the time series that you are considering. In this instance, it's money supply, which is very, very important, and this basically breaks down all correlation with the previous periods, and it poses a lot of challenges, a lot of problems from a econometric and statistical standpoint. But anyway, the machine gives us a forecast, so we're happy with that. And the shaded area, it's large, so the lower and upper bounds are wild, but we want to consider that money supply will be steady around 3.3, 3.4, 3.5%. So there will be money supply, and these are money supply is the optimal input for for inflation. So we can reasonably expect that inflation will not easily converge to 2%. And what will do the Federal Reserve? I don't know. I don't want to know what the Federal Reserve will do. It's their problem, not mine. So another here, this is core PCE, this is core personal consumption expenditure, very good p-values, large kurtosis, and we see here standard normal, very large kurtosis. We have lot of stationarity, and we have seen this bar after the 10 period, around 12 period, a lagged seasonality. We've seen also in other previous charts. And core PCE, core expenditure, would slightly go up next year. So this will basically, these are only the first 2 months of 2025. I should have refined the model and asked for 4-quarter forecast. I did it, but I have so many pages here, you have no idea, and I can't find everything I want to find in a reasonable time. So yeah, FedFunds, very stationary, p-values are good, moving average not so good. Yeah, we cannot, I mean, it's not easy to have a moving average with this kind of chart, because this is more of a step function. It goes up and down by steps, it's not a smoothed function. But yeah, FedFunds will go down in the coming months, a sort of 25 to 50 basis points reduction in FedFunds to be expected. Total bank credit, yeah, the usual 12 period here of seasonal residual autocorrelation, but the p-values I didn't like it. So yeah, we have the forecast, it's a very limited forecast. I don't think it gave us a forecast at all, because the value that came out is basically the same number, so I would discard this thing. And yeah, last but not least, yeah, these are basically the aggregate of all credit cards, which is more than like 1,070 billion. Yeah, it should be a stabilization of credit card, line of credit creation. There's a lot of kurtosis in the this series. Yeah, see a big bar here and lots of extreme values from plus 60 to minus 60, but with small frequencies. So yeah, and yes, so going forward, I mean, to add up something, I have to say that I've showed you 2 ARIMA, but I did at least 3 or 4, even more. I did a lot of optimization of ARIMAs to see what were the outcomes, and if I had different graphs and charts. So very briefly, I yes, of course, did my usual VAR with 1 to 4 lags, and yeah, I did also some Garch models, because I was interested to see the volatility of this time series. We can try and quickly go through this and see what they tell us. I know it's not really, yeah, this is another ARIMA, and yeah, we have a similar outcome. Yeah, they're pretty much the same. FedFunds decreasing, this is core CPI stabilizing. Yeah, as I said, I did a lot of work with this data, and still I'm not satisfied. I have to say, I'm not completely satisfied. Yeah, so the usual producer price index, we have pricing volatility recently, and yeah, the p-value for the beta tells us that this is volatility for the producer price index, has some kind of persistency, let's say. Yeah, okay, so this is CPI. Oh dear, no, I think I made a mistake. forgive me. So yeah, okay, forgive me. So this is the Garch model for this, okay? And this p-value, they are all very relevant, okay? They are all very small, smaller than 0. So the baseline volatility, omega, is very consistent. And also the alpha and the beta parameter for the producer price index, they tell us that producer price index can have basically volatility changes or shocks based on alpha parameter, so exogenous factors like tariffs or commodities prices, like raw material prices that increase in other countries. So, and the persistency, somewhat there is a persistency of the volatility that slowly decays and decrease. Then these are for core stick inflation, and also only the beta parameter, it's relevant. It's a very high beta parameter. And yeah, then CPI p-values, they are good for the omega, so the baseline volatility or variance, it's here. And we have an alpha parameter. So CPI also, it's determined by exogenous factors or new information that can have a change on CPI. And we see that here the range here it's 0.15, 0.7. There is no zero in between, so we can take it as a good parameter, this alpha parameter for CPI inflation. And this is basically, it's very low volatility. I mean, we are talking about stuff of the economy. These are not financial assets, but so money supply Garch model. Yeah, here these are very good p-values, and we have alpha parameter, so money supply, new incoming information that can explain 51% of what happens to volatility in money supply, which is gone up and down like just recently in 2024. And the baseline variance or volatility, the omega. Core PCE, let's see how it is. Yeah, very significant alpha and beta parameter. So core PCE, incoming alpha parameter, incoming information, exogenous factor, explain 29% of volatility of core PCE. And the beta parameters 50%. There is somewhat of persistency. And yeah, we see a decline in core PCE, conditional volatility. This is core inflation, core CPI, and only the beta parameter is relevant, exactly as CPI. Yeah, low conditional volatility at the moment, and I think that policymakers will hope so. Federal funds, I don't think there is any volatility in federal funds. Yeah, the p-values then. This shows the recent volatility of Fed funds going up and down. The 500, more than 500 basis points change in Fed funds, it's all in this volatility here. And this is probably tracing the recent cuts that have been implemented, reduction. Total bank credit, let's see if we find anything interesting. The alpha parameter, beta parameter, they can be considered, and yes, the beta parameter is very large, 83%, so the conditional volatility of total bank credit is quite persistent. So total bank credit, it's as a conditional volatility persistency factor, and the alpha parameter 16%, exogenous new information for total bank credits, banks, like I don't know, anything that can has to be factored in by banks for giving credits, etc. Credit cards, volatility, here we have it, very low. What are the parameters? Alpha and beta parameters. The p-value is good. There is no zero in between these ranges, so also it's good. And alpha parameter 35%, beta parameter 64%, they all add up to 1. Very good. So this is the Gatch model, worked very well. And these are again the same things. So let me go through the VAR one of the VAR models. Let's pick and choose this one. Let's see if we find anything interesting. I'll just go through quickly. Okay, let's do this. Let me. I can't see the code. Oh dear. And so impulse response. Let's see how things change here. Let's try and take this one. So now I don't want to hold you a lot, but basically what we've seen up to now is that money supply it will continue. Total bank credit is the forecast is for a continuation of money supply and bank credit, and we have a stabilization of inflation, and some metrics, some parameters could be rising, could be increasing going forward. And at the same time, the model gives a forecast of a decreasing federal fund rate. So this is very funny, very cunning, because the Federal Reserve could find itself in a policy error. Yeah, this is very big thing to say. Like, the Federal Reserve could decrease interest rates and then find out that with some lagged period, after one month or 1 quarter, the rate of inflation, it turns around and rises again. That will basically have the Federal Reserve is offside. They will have to check again their models and see if it will be a big time, because if there is a policy error and then they have to walk back their interest rate cuts, it's something that very rarely happens, and I don't think it's anything of the sort that policymakers would go through. I'm trying to I think if I take the page here, so it will be easier for me to find what is the correct. Okay, bar model, lag model. Oh yeah, let's go through this one. Yeah, because what I achieved with this one is to get stationarity for non-stationary time series. Okay, so we'll go through quickly this. Yeah, let's see if I find it on the PDF. I'm sorry, I will be quick with this. Yeah, let's see what are the data here, and then I'll show you some other graphs, etc. So we managed to input the stationarity. If the time series is not stationary, please do the residual. Okay, so differentiating applied, etc. Blah blah blah. So log likelihood it's quite a large number. It would be better to have a log likelihood that it's smaller or closer to 0, so that it tells you that the model fits better. But we'll work with what we have now, and we'll try to I will read the data for the first or second time with you now, and we'll see what happens. So what are the outputs? So we'll start as usual for the producer price index, which there is, after one lag period there is a correlation with the same time series. It's a slam dunk, it's okay. But after one lag we see that there is a reaction for the FedFunds. Here the p-value, it's close to 99% confidence, and there is 1.9 coefficient for 1 unit of change in producer price index. The FedFunds changes, the coefficient of change is 1.9. So it's quite significant data to have. Second lag, we have a negative coefficient from CPI. So if PPI adjusts after 2 lag period, we have a negative coefficient in CPI. If we raise interest rate, probably inflation tends to adjust downwards, or for example if producers are pricing higher costs for their raw materials, then after 2 periods inflation does not increase so much, because they priced in already what is the supply side effect of higher cost for producers. This could be an explanation, but you see this stuff requires a lot of work. At second lag we have a negative FedFund coefficient. Okay, so if we have a positive coefficient here, 1.9, we have a negative coefficient. If we sum up, it's minus 1.8. It's very interesting. And we have a negative third lag, negative core inflation. Negative coefficient for core inflation, positive coefficient at third lag for core PCE, right? And then we have positive third lag, kicks in the credit card creation, credit, positive coefficient. Let's see if anything else. So this comes out only from having impulse response function generated by the producer price index. Let's see what happens for core inflation. Core inflation, we have first lag, we have a negative coefficient from money supply, and then we have here very large T-stat, still always money supply, positive coefficient, and then here, what is this? So core stick inflation, negative coefficient at third lag for producer price index, third lag negative for money supply, etc, etc, etc. I don't like to hold you to all this data, but this is the sort of work that anybody has to go through and to double check what this graph, these charts mean. And yeah, let's try to see the charts very quickly. Yeah, we see that for increasing producer price index, we have positive response and then a negative response from core stick inflation, core inflation. And here we have a very large shaded area, so there is a lot of uncertainty, but basically producer price index, they tend to have a pass-through feeding effect on CPI. So the higher is the supply side cost for producer, the higher will be inflation. And while it's let's say volatile, the response function from this is core PCE, because this producer price index is for all commodities. So this is core consumer spending, that it's more focused on core services. It could be less correlated with commodities or raw materials. But anyway, positive impulse, and then the response of core PCE tends to decline and decay, let's say, and flat line around this range is very close to zero. Here we have very flattish correlation impulse response function from between producer prices and money supply. I think so it could be quite the opposite, the other way around. Producer price index, core CPI, core inflation tends to go higher. So producer price index, broadly speaking, it's more relevant for CPI inflation and core CPI inflation. It tends to have a pass-through effect. And producer price index is a factor for FedFunds, right? But we see that it's not a factor for money supply. But we have the same problem that we stuck. It's like a dog that wags its tail. I'm sorry. Basically, we go round and round in circle around the same thing. That we can move up and down interest rate, but credit creation and money supply continues, and we don't have, for example, a response here in money supply, like a decreasing money supply, if for producer price index, or we'll see with other variables how this pans out. So here completely the opposite. Producers price index, we have a positive response from the credit cards time series, more credit cards, more money created if there is a positive impulse from producer prices. So same is for total bank credit, it keeps up. So if producers, they need to basically acquire goods and services and raw materials that they need, so credit is created for producers to afford the supply side effect of rising cost. Here, core stick inflation, negative response from producer prices, and this is the same. And then core stick inflation, there's a negative response from money supply, but considering this wide area, I am not gonna take as good this graph, because the shaded area is from +2 to -6 is too wide of a range. So this has to be checked with other parameters. So here we have core stick inflation, and we see that it has a positive impulse on CPI inflation, and then it decays. It can have a negative response on CPI. If core inflation is declining, also CPI will be declining. And this is core PCE expenditure. It's correlated, and it's not really much volatile with core inflation. We know that in the latest data, core inflation has been going down. So we have here, what we see here is what should be negative responses from core PCE, consumer spending, core consumer spending. Okay, it's core inflation, core stick inflation with core inflation, two of the same measure. And yeah, let's try and find something more interesting with money supply. Yeah, okay. If I have a positive impulse from money supply, then we have positive outcome for core inflation, and it's quite stable. Positive impulse of money supply, we have a very positive response. I mean, producer price index tends to have a positive response, so it will increase. And then again, money supply, printing money, CPI inflation, high inflation. Oh, this is basically the same thing. Positive impulse response, but it's more measured with respect to this one. It's almost the same range, not 0.04. But this is core inflation, and it's more similar to core stick inflation. There's a positive response, but it tends to stay in a range. But still, it's accumulating inflationary pass-through effects from money supply to inflation. Yeah, this is money supply, core consumer spending, same range, but still it's a positive effect on consumer spending. And this is the response of federal funds. This is quite intriguing because money supply, there is no inputs, there is no response, but this means that you can change interest rate, but credit creation continues. Yeah. Yes, and there are a variety of data that I worked through, and I had a lot of VAR models that I worked through. Basically, the main takeaway from today is that probably we will have rising inflation going forward, rising producer prices, and a continuing of money supply that could be increasing in 2025, either by bank credit creation or by fiscal spending or some other factors. But we have basically the Federal Reserve runs the risk of cutting interest rate, while inflation could be going higher in the coming months and quarters, and there will be a continuum of money supply, and this could be very problematic for market, for financial assets, for monetary policy, and so we will have to see. We will have to see what will decide the Fed this month, if they will cut, and what it will be very interesting to see what will be the outcome for financial assets. And with this, basically, I'll end the video, and I'll invite you all to come and see my website. If you want to read about macroeconomic research and on my market journal.com, you're very welcome. And for now, please drop a comment, thumbs up, leave a like, and see you next time. Thank you all.